esteemed Dr. Michael Debabrata Patra, Professor Muchkund Dubey, Professor Shanta Sinha, and other delegates. A very warm welcome to all of you to the 18th CD Deshmukh Memorial Lecture. Given the context of pandemic, this time we are organizing this lecture in virtual mode. We are missing all the joy of having all of you in our premises at CSD. CSD is a leading research and policy studies institution that puts equality and justice at the core of social development. Established in 1962 in New Delhi, CSD emerged as an intellectual and social sciences academic hub under the leadership of the legendary freedom fighter, social activist, academician, and planner Dr. Durgabai Deshmukh. In 1964, the CSD became formally affiliated to the India International Center, and in April 1970, it was registered under the Societies Registration Act of 1860 with Dr. C.D. Deshmukh as the president and Dr. Durgabai Deshmukh as executive chairperson and honorary director. The Southern Regional Center CSD was established in Hyderabad in 1967. CSD engages in policy-oriented research with a special focus on social aspect of development planning and concern for social justice and equity that continues to guide the work of CSD. The major research at CSD is to encourage examination of diverse impacts of policy and appreciation of diversity in understanding the relationship between the state and the people. The current president of CSD is the distinguished former diplomat Professor Muchkund Dubey. Currently, Professor Shanta Sinha is the chairperson of the managing committee of the Southern Regional Center, Hyderabad. During the sixth five-year plan period, the Indian Council of Social Science Research, New Delhi, sanctioned a recurring annual grant to the Southern Regional Center. Further encouragement came from Reserve Bank of India, and since 1985, RBI has been funding the institute, especially the RBI chair professor, which is in vogue in several other institutes of the country. The government of Telangana has been supporting the council by way of an annual grantinate since 2011. CSD organizes memorial lecture in honor of founders Dr. C.D. Deshmukh at the Hyderabad Center and Dr. Durgabai Deshmukh at the Delhi Center. We have had 17 lectures so far at the Hyderabad Center by eminent personalities like Dr. S.R. Sankaran, Justice B.P. Jeevan Reddy, Sri M. Narasimhan, Dr. C. Rangarajan, Professor C.H. Hanumantrao, Sri N. Ram, Dr. L.C. Jain, Professor A. Vaidyanathan, Professor U.R. Rao, Dr. B. Subbarao, Professor S.K. Thorat, Professor Faijan Mustafa, Justice J. Yakub, Professor Ashwini Deshpande, Dr. Paranjay Guha, Dr. Ranveer Samdar, and Professor Joya Hosni. We have with us today Dr. Michael Debabrata Patra, Deputy Governor, Reserve Bank of India, to deliver the 18th CD Deshmukh Memorial Lecture. It is a great honor to have you with us, sir, today. Dr. Michael Debabrata Patra, a career central banker, is the Deputy Governor responsible for monetary policy, financial markets, deposit insurance, research and statistics, international relations, and corporate strategy of the bank. He is a member of the Monetary Policy Committee of the Reserve Bank of India, which is invested with the responsibility of monetary policy decision-making in India. He has served in the International Monetary Fund as Senior Advisor to Executive Director India during the December 2008 to June 2012. He has published books and several papers in the area of inflation, monetary policy, international trade and finance, including exchange rates and balance of payments. A fellow of the Harvard University where he undertook postdoctoral research, he has a PhD in economics from the Indian Institute of Technology, Mumbai. I extend a very warm welcome to you, sir. We have also with us today Professor Shanta Sinha, who is a leading child rights activist, and she has headed the National Commission for Protection of Child Rights as its first chairperson for 2 consecutive terms from 2007-2013. She has also served as a professor, Department of Political Science, University of Hyderabad. Currently, she is the chairperson of the managing committee of CSD Hyderabad. She is also a recipient of Raman Magsaysay Award in 2003 for the community leadership and the Padma Shri in 1998 by the Government of India. She is also the founder secretary of MB Foundation. I extend a very warm welcome to you, ma'am. All of us know the most sectors of the economy had came to a standstill due to impact of COVID-19 pandemic and the resultant lockdown in India and elsewhere. The uncertainties with respect to joblessness have become more severe than the infection from the virus in the present context. A sustainable solution to these uncertainties is the urgent need of the hour. It is in this context that we have requested Dr. Patra to share with us his reflections based on his experience in the context of pandemic. I also extend a very warm welcome to the participants of this event who have joined us online from different parts of the country. I now hand over the proceedings to today's event to the chairperson, Professor Santa Sinha. Over to you, ma'am.
Thank you. Good morning. It is indeed a pleasure to be here today and a great honor that we have Dr. Michael Debabrata Patra, Deputy Governor, Reserve Bank of India, to deliver the 18th C.D. Deshmukh Memorial Lecture and on a very important topic on RBI's pandemic response, stepping out of oblivion. How appropriate this is. It is important that I also mention that the CSD has been supported by RBI through its funding for its chair, and we are ever grateful for you for this. I think it is an occasion to also look at further collaboration with the RBI, and we really look forward to it. I'm also glad that Professor Muchkund Dubey, who is the chair of the CSD, is with us today, and that there is this august audience who, in spite of COVID, are all with us. In fact, many of us are recovering from the pandemic ourselves. I mean, the third wave has come and it has affected perhaps every family. And I really sometimes wonder how long one will have to go through this kind of a horrible situation. All of us are aware that the pandemic is uh, unprecedented, both in its spread and impact across the globe. Millions of lives have been lost. The long term effects of the disease are still being studied. For the first time in the history of mankind, nations were shut down across the globe. The widespread devastation of life and the severity of the pandemic continues to haunt the global economy. The prolonged subsequent lockdown, which was the response in 2020 to prevent the spread of virus, affected nearly every segment of the population. We all know that. The closure of shops and establishments, small and medium scale industries, service sectors that worked on personal contact, uh, and also the way it hit a large number of low skilled wage workers, migrant labor, the rural and urban poor. The pandemic has been quite cruel and uncharitable. Uh, More than anything else, there has been a loss of livelihoods many thousand times over permanently. I am actually even more concerned about closure of schools that push children into labor force, girls into child marriage, untold hunger due to non-availability of noon meal scheme, and loss of education. One cannot imagine the intergenerational impact of this loss of education for children, their well-being, as well as for the country as a whole. And of course, we have seen how the 2021 hit us the hardest with critical health infrastructure being stressed to the breaking point. Indeed, the impact of pandemic, unlike the earlier financial and banking crisis or even demonetization, has affected the vulnerable sections most, exacerbating inequality. The gap between the poor and rich has only further widened. A recent survey, the ICE 360, shows that the poorest 20% Indians saw a decline in their incomes by 53% in 2021, compared to an increase of 39% in the incomes of the richest 20% of the population. It is hard to imagine what the impact of such inequitous relationship would be on India's texture of democracy and the economy as well. It is in this context, I think, what we will hear from Professor Debabrata would be very, very important. We all know how RBI, which is the central bank, has a huge role under these circumstances to maintain financial stability and retain confidence of the common man that the bank. And I think we all know we have faith in the RBI because we think the bank knows what needs to be done. With increasing integration of the global financial system, the need for a coordinated response across the central banks around the country and the globe could not have been more imperative than ever before. In fact, RBI has been one of the few banks in the world that has been people centric. The Asian crisis of 1998 and the global financial meltdown of 2008 are two fine examples when RBI came up with responses which protected the vulnerable sections of the society from the ravages of exchange volatility, rising interest, inflation, and sudden loss of liquidity. Of course, all of us agree that even for the RBI, the current pandemic, this phenomena, is nothing like the earlier economic crisis. Its initiative, I must say, that we must acknowledge in the context of current pandemic to protect the economy, especially the small and medium scale industries and establishments, to protect the informal economy and to respond to the suffering of the poor and their huge loss of income and livelihoods is something that we must acknowledge. You know, it has taken a principled stand that the financial institutions has an obligation to reach out to the weakest and the lowest in the social and economic pyramid. While it is, I think, setting standards, the challenge remains on how it is actualized in practice. The challenges are indeed many. How do we reconcile financial stability in future while unwinding COVID support measures during the recovery process? The delicate balance between the demands to provide access to liquidity and credit to all sections of the society while containing inflation is yet another challenge. This pandemic has delayed the process of financial inclusion, wherein all sections of people must have access to formal financial systems. RBI, as we know, has a challenging task to take this agenda of financial inclusion to a logical conclusion. In fact, most of the measures of how healthy the economy is on looking at the GDP. I think the pandemic has told us that it has to go beyond GDP to look at how inequality and is bridged and the process of recovery is speeded up just so that the asymmetrical relationship between the poor and the rich does not continue. Sir, we have great expectations of the RBI to be in the forefront of strengthening the process of dialogue between all stakeholders in the financial system: the government, policymakers, corporates, civil societies. The reality is, while RBI alone cannot sorry, yeah, while RBI alone cannot tackle the crisis of the pandemic, it can certainly lead a coordinated response to provide a much needed relief to vulnerable individuals and also the corporate sector. It is hoped that RBI finds a path that would see the well being of the citizens and the health of RBI are mutually interdependent and not irreconcilable. I thank you very much for giving me this opportunity to share some of my random thoughts on the issue, although I am no expert on banking institutions or even the RBI. This is a common person's angst during the pandemic. We look forward to hearing Dr. Michael Debabrata Patra today. And I once again thank you on behalf of Council for Social Development for accepting to deliver the 18th CD Deshmukh Memorial Lecture. Thank you very much. And I hand over this to you.
Namaskar. Good morning to you all. Professor Muchkund Dubey, President. Professor Shanta Sinha, Chairperson, Managing Committee. Professor Sujit Kumar Mishra, Regional Director in charge. Dr. Sunny Jewels, RBI Chair, faculty and staff of the Council for Social Development, Hyderabad, hereafter CSD, students, researchers, and faculty joining this event from various universities and research institutions across the country, colleagues, and friends. It is indeed an honor to share my thoughts today under the prestigious C.D. Deshmukh Memorial Lecture Series instituted by the CSD since 1997. For the Reserve Bank of India, hereafter RBI, this lecture series has a special significance. Late Shri Chintaman Dwarkanath Deshmukh was the first Indian governor of the RBI from August 11, 1943 to June 30th, 1949. His association with the RBI began even earlier in July 1939 when he was appointed liaison officer to the RBI by the Government of India. 3 months later, he was appointed Secretary of the Central Board of the Bank. 2 years later, in December 1941, as the Deputy Governor, and then Governor on August 11, 1943. He presided over the transformation of the RBI from a private shareholders bank to a nationalized institution. Under his stewardship, a comprehensive legislation for the regulation of banking companies was enacted. Another landmark legislation under his leadership led to the establishment of the first financial institution for the provision of long-term credit to industry, namely the Industrial Finance Corporation of India. He also played an important role in the Bretton Woods Conference in New Hampshire, the United States, in July 1944, which led to the establishment of the International Monetary Fund and the International Bank for Reconstruction and Development, IBRD, or as it is popularly known today, the World Bank. His vision and ideas still resonate in the corridors of the RBI. Among his many outstanding contributions to society at large, late Shri Deshmukh and his wife, late Srimati Durgabai Deshmukh, played a pioneering role in the establishment of the CSD in 1962 as a leading research and policy studies institution. Today, it is a matter of national pride that the CSD engages in policy-oriented research with a special focus on social aspects of development planning, social justice, and equity. Research at the CSD continues to evaluate the diverse impacts of policies on the relationship between the state and the people. Our association with the CSD goes back to 1985, when the RBI chair professorship was established. It is also a matter of considerable satisfaction that many of our officers have been associated with the CSD in their paths of self-actualization. Against this backdrop, I turn to the theme of my address today, which is the RBI's response to the pandemic, and I have euphemistically described this journey as stepping out of oblivion. When COVID-19 engulfed the world in early 2020, humans had become oblivious of pandemics past. Yet, 100 years ago and before, between 1817 and 1920, cholera, plague, and influenza pandemics had visited the world repeatedly and wreaked havoc. Of the estimated 70 million lives lost worldwide during that time, roughly the same as the casualties of the 2 world wars put together, India had accounted for nearly 60%, and yet somehow we had erased those memories. After all, astonishing progress had been made in the control of diseases. Food and nutrition were more plentifully available, and we had learned to deal with natural calamities more effectively. As a result, longevity, which was as low as 25 years in 1920, had risen to 70 years by 2020. For these insights, I draw heavily on Chinmay Tumbe's delightful book, The Age of Pandemics. In fact, the author in that book describes living conditions in 1920 very well, very evocatively. He speaks of those times as we barely lived before we died. Back to my theme, if we had remembered those times, we would have prepared for the fact that influenza can evade pre-existing immunity by mutations. We would have recalled that infections, in the case of the 1918 influenza pandemic, up to 4 waves occurred, lasting up to 1920. I'm sure none of us remember anything about the 1918 influenza wave. It was called Spanish flu. If that may ring a bell. In any case, our consciousness should have been stirred to the fact that beyond the usual symptoms of fever and body pain, infections turn pneumonic very quickly, allowing bacteria to attack the lungs. In hindsight, it is this loss of collective accumulated knowledge that allowed COVID-19 to catch us off guard. In fact, this loss of memory resulted in irrational actions. The declaration of COVID-19 as a pandemic by the World Health Organization, or WHO, on March 10, 2020, and India's nationwide lockdown that followed set off one of the biggest migrations in human history as people fled cities in fear of what was widely perceived as an urban disease, only to find that the virus pursued them to their villages. In some sense, this amnesia was global. To illustrate, the WHO, which is mandated to declare pandemics, did so in respect of H1N1, the famous swine flu, in 2009. But that came to be seriously questioned because it turned out to be unusually mild, and scrutiny focused on pharmaceutical industries which benefited from the production and sale of vaccines. The severe acute respiratory syndrome or SARS, the Middle East respiratory syndrome, coronavirus, that is MERS-CoV, and Ebola did spark pervasive alarm, but casualties were relatively few and the incidence of infections was localized. By contrast, the 2020 pandemic caused worldwide contagion and the precipitous loss of lives and livelihood. By the end of 2021, several advanced economies may have reached or even exceeded pre-pandemic levels of output, but middle-income emerging economies have suffered large losses of output, with the heaviest burden falling on low-income countries. Within economies, inequality has widened alarmingly, and Professor Shanta Sinha spoke of how the poor have become abjectly poorer. The pandemic is also noteworthy for the unprecedented policy response mounted by governments and central banks. The IMF estimates that since March 2020 and right up to October 2021, $16.9 trillion or 16.4% of global GDP has been pledged as fiscal support in response to the pandemic, with $14.5 trillion provided by advanced economies and $2.4 trillion provided by emerging market economies, including the least developed countries. The total monetary support was $19 trillion or 18.4% of global GDP, $16.1 trillion by advanced economies, and $2.9 trillion by emerging market economies. So what guided this once-in-a-lifetime policy response, given the collective oblivion that I talked about earlier? It was the global financial crisis of 2008. Typically in crises of global proportions, it is governments of fiscal policy that assume a vanguard role, while central banks, known for their conservativeness and preference for the back office, play a supportive role as what is termed as lenders of the last resort. In response to the global financial crisis, however, it was central banks that rushed to the front line. faced with the loss of their main instrument, that is the interest rate, which had fallen to zero. And at that time, zero was considered the lower bound to which interest rates could ever decline. Of course, that myth has been shattered in later days. We find interest rates have fallen into negative territory. But with the loss of this instrument did not deter central banks. They went on to unleash unconventional measures using their balance sheets to support economic activity, providing forward guidance to stabilize expectations and anchor the uncertain future, and directly influenced longer-term yields at the cost of being accused of the cardinal sin of effectively monetizing stimulus-distended fiscal deficits. In that sense, they did have some sort of a template when the pandemic arrived. Now let me turn to RBI's response to the pandemic. Among the first steps that the RBI took within 6 days of the WHO's declaration of COVID-19 as a pandemic was to create a business continuity biobubble. In the event of all of us becoming infected, 150 selected officers, staff, and service providers were kept in isolation in the bubble to work 24/7 in order to keep essential RBI services such as currency issue, retail and wholesale payment and settlements, financial market regulation and supervision, and liquidity management, to name only a salient few that impact the lives of citizens, businesses, and financial institutions on a regular basis. This move turned out to be far-sighted. Within days of the national lockdown being announced, financial markets in India went into seizure. Financial institutions were gripped by liquidity evaporation, and finance, which keeps the wheels of the economy turning, dried up. From March 27, 2020, the RBI unfurled a panoply of measures numbering more than 100 in total, some conventional and others out of the box, to address pandemic-induced dislocations and constraints, both system level and also specific to sectors, institutions, and financial markets. In terms of conventional measures, the policy rate was reduced by an unprecedented 115 basis points in 2 phases. The interest rate on the fixed rate reverse repo under the liquidity adjustment facility of the RBI, under which market participants can deposit surpluses with the RBI, was reduced cumulatively by 155 basis points, and it became the effective anchor for the evolution of money market interest rates and even longer-term interest rates. Banks' access to liquidity under a marginal standing facility, which is a lending window that is priced 25 basis points above the policy rate, was expanded by close to 1,37,000 crores. System-level liquidity was also enhanced through large-scale open market purchase operations and a 1 percentage point reduction in what is called the cash reserve ratio. And all this freed up banks' resources to the extent of close to 1,40,000 crores. Turning to unconventional measures, long-term repo operations and targeted long-term repo operations were undertaken to augment systemic liquidity, lower the bank's cost of funds, and influence longer-term interest rates more directly. While long-term repo operations, or LTROs, enhanced overall liquidity, the targeted LTROs or TLTROs ensured the distribution of liquidity to specific sectors in need of funds. Additionally, when redemption fears gripped the mutual fund industry, a special liquidity facility was put in place for mutual funds and was virtually crafted over a weekend. When these liquidity measures encountered risk aversion among banks in on-lending the RBI's funds to troubled entities, special refinance facilities were provided to all India financial institutions to mitigate sector-specific and small institution-specific liquidity constraints. On-tap TLTROs provided liquidity to banks for deployment in corporate bonds, commercial paper, non-convertible debentures, and bank loans to specific sectors. In the first half of 21-22, the RBI pledged its balance sheet to mitigating the impact of the pandemic and reviving the economy. From April through September 2021, the RBI engaged in asset purchases through a secondary market government securities acquisition program, which involved an upfront commitment on amounts to be purchased, and this impacted yields directly. In addition, special open market operations involving simultaneous purchase and sale of securities were undertaken to distribute liquidity more evenly across the yield curve, thereby facilitating monetary transmission. Overall, all the measures taken by the RBI worth rupees 17.2 lakh crores or 8.7% of nominal GDP were announced since February 6, 2020. These specific aspects of these measures can be found in various documents, and my speech will provide the references where one can find them easily. Forward guidance gained prominence in the RBI strategy. In every statement of the Monetary Policy Committee, it was reiterated that the policy stance would remain accommodative, including with explicit time contingent and state contingent guidance. Financial markets were assured that the RBI will maintain congenial financial conditions for sustaining the recovery. This dispelled illiquidity fears and bolstered market sentiment. While monetary and liquidity measures address the immediate panic, the dislocations in everyday activity and access to finance brought to the fore solvency concerns among individuals, small and large businesses, and raised fears of impending asset quality stress among banks and financial institutions. Accordingly, the RBI launched a suite of regulatory measures that included a loan moratorium, asset classification standstill, easing of working capital financing and deferment of interest, increasing of group exposure norms, restructuring of advances to micro, small, and medium enterprises, and reduction of liquidity coverage requirements, to mention the main initiatives. These steps provided a temporary reprieve to borrowers affected by the pandemic and shored up the health of lending institutions, thereby preserving the resilience of the financial system. Several counter-cyclical regulatory measures were also undertaken to ease stress on both borrowers and the banking system. These were rationalization of risk weights for individual housing loans, revised risk weights for banks' regulatory retail portfolios, and restrictions on banks from paying out dividends. On the technological front, the RBI adopted a proactive approach by leveraging on technology to facilitate digital penetration, innovative payment options, and consumer awareness on the road to a less cash-reliant society. A few initiatives were customized, keeping in view social distancing and contact protocols of the pandemic, including ensuring availability of digital banking channels, ATMs, internet, mobile banking facilities, strengthening cybersecurity, developing mechanisms for faster redressal of customer grievances, and improving financial literacy through sustained and focused campaigns such as RBI Kehta Hai. The RBI Kehta Hai is a 360-degree campaign initiated by the RBI using all mass media, including television, radio, newspapers, hoardings, web banners, GIFs, social media, and SMS. Let me turn to the impact of these measures. The full impact of these measures is still unraveling, and even when the outcomes have fully formed, a one-to-one correspondence may be difficult to establish, given the many moving parts that are involved. Notwithstanding this caveat, however, the overall state of the economy and of financial markets, which is what these measures sought to address, provides some evidence of the efficacy or otherwise of the RBI's pandemic response. Ahead of the pandemic's onset, the Indian economy was already into a cyclical downturn, with real GDP growth having decelerated in 2019-20, the pre-pandemic year, to its lowest rate in a decade. Consequently, monetary policy had already turned accommodative from February 2019, with a cumulative reduction of 135 basis points in the policy rate up to February 2020. System level liquidity was already in surplus from June 2019 in consonance with the stance of monetary policy. At the end of February 2020, market participants were depositing excess liquidity of the order of rupees 3 lakh crore under the liquidity adjustment facility of the RBI. The first quarter of 2021 bore the full brunt of the pandemic's onslaught, with mobility of people and goods dropping to all-time lows. Real GDP contracted by a precipitous 24.4%, which was among the deepest in the world. Unemployment peaked at 24% in April, although in rural areas, farm activity displayed pandemic proofing, and the Mahatma Gandhi National Rural Employment Guarantee Act provided a measure of insulation. Exports plunged 61% in April, with a commensurate decline in imports. The National Statistical Office could not collect price quotations for compiling the Consumer Price Index due to the nationwide lockdown and had to resort to imputations. By early June, the fury of the pandemic abated and the pace of infections started to ebb. This emboldened the unlocking of the economy in a phased manner that took up to the end of December 2020 to be completed. As businesses haltingly resumed activity and mobility around workplaces, grocery stores, and pharmacies improved, out-migration started to reverse and the unemployment rate eased to 10.2%. Supply and work disruptions showed up in inflation surging to 6.2% in June. The Indian economy remained in contraction in the second quarter of 2021, and it was in the second half of the year that, on the back of policy stimulus, festival-related spending, and the release of pent-up demand, a hesitant and uneven recovery started taking shape. Meanwhile, the RBI's measures had brought down borrowing costs to their lowest in 17 years and had narrowed spreads across rating categories on corporate bonds, commercial paper, and debentures to pre-pandemic levels. By engendering congenial financial conditions, the RBI supported the recovery. Governments of various levels, center and states, as well as corporates, utilized this window of opportunity to raise a record volume of resources from the financial markets. In the corporate sector, deleveraging was facilitated and high-cost debt could be replaced, reducing vulnerabilities and preparing the sector to participate in the ongoing recovery. Abundant liquidity and the RBI's measures enabled a quick and full transmission of policy rate cuts to deposit and lending rates, easing the cost of funds for bank customers. The second wave dented the recovery in the first quarter of 21-22, the current year, but its impact turned out to be relatively less severe. The Indian economy renewed its tryst with the interrupted recovery, which gained strength and pace during the rest of the year. Currently, it is estimated that real GDP will rise by 9.2% during the current financial year, cresting pre-pandemic levels and making a turnaround from the decline of 7.3% the year before. Exports have been the silver lining, growing by 49.7% year-on-year in US dollar terms during April-December 2021, at a time when international trade has been hamstrung by supply chain disruptions, shortages, and logistics impairments. Import demand has also surged on the back of the return of domestic demand to near normal conditions. Employment has yet to recover fully though, and labor participation remains low. Bank credit has begun to gain pace, helped by the easing of stress in banks' balance sheets. Inflation has eased from pandemic highs to more tolerable levels in recent months, although it remains elevated amidst high international commodity prices, including of crude oil. To summarize, the RBI's measures have contributed significantly to engineering the turnaround in the Indian economy, supported by rising financial inclusion and digitalization. We are on course to becoming one of the fastest growing economies of the world, but there is far to go. Private consumption and investment are still work in progress. The restoration of livelihoods and the revival of MSMEs is a formidable task that lies ahead. The RBI, on its part, remains committed to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. When the definitive chronicle of this period is recorded, history will judge the role of the RBI in ameliorating the impact of COVID-19 and in lifting the Indian economy out of the depths of the pandemic's contraction. I would not hazard the audacity of anticipating the judgment of history, but today, there is all-round recognition that India is much better placed to deal with future waves of the pandemic relative to the first wave. In the documentation of this journey, however, what I fear may not receive a full appreciation is that the RBI's pandemic response was fashioned around and launched with a central anchor, a light motif, if you will, that bound everything together into a coherent whole. I refer to the governor's statements, which have become an integral element of the institutional edifice of the RBI's pandemic response. I therefore propose to balance the future narrative upfront by sharing with you an insider's view of some noteworthy aspects of these statements that may go unnoticed among the minutiae of rationale, high-frequency indicators and measures. Delving deep into hidden inner reserves of self-belief, conviction and fortitude, and guided by the light shown by the words of Mahatma Gandhi, Governor Shri Shaktikant Das has made 13 pandemic statements so far, starting in March 27, 2020, when the Monetary Policy Committee advanced its scheduled meetings to deal with the extraordinary and unprecedented situation. The first noteworthy characteristic of these statements is that they have been visionary. In fact, the statement of February 6, 2020, ahead of the formal declaration of the pandemic, seemed to have a premonition of the dark days that were to follow. This is reflected in the manner in which it assured markets that policy space is available for future action, but it needs to be suitably timed and used appropriately. I'm actually quoting phrases out of that statement. The March 27, 2020 statement called on the nation to mount a war effort to combat COVID-19 while emphasizing, and I quote, "Tough times never last, only tough people and tough institutions do." My sense is that a vision of the unprecedented loss and isolation that was to follow was already in the mind's eye when that statement soothed frayed and tense expectations by stating that the RBI, and I again quote, that the RBI is at work and in mission mode. It became the launching pad for aggressively unleashing an array of instruments covering many of the liquidity and regulatory measures which I have spoken about, as well as the deferment of prudential standards. Secondly, the statements were a beacon of light and hope amidst the encircling gloom. Besides the steadfast encouragement to the nation to battle the unseen assassin and emerge victorious, they cheered the warriors at the front line. Government personnel, employees of banks and financial institutions, doctors, healthcare and medical staff, police and law enforcement agencies, and all those who kept essential services operational. Those statements commended their tireless striving to beat the virus and inspired them to raise the bar. For us in the RBI, the messages were special and personalized, reaching out to those in the bio bubble and those outside it. including those who provided intellectual, analytical, and logistic support for the preparation of the statements. In the thick of the second wave, the statements of April 7 and June 4, 2021 reposed a belief, and again I quote, in the indomitable spirit of humanity to confront the trial by virus. They stated that the need of the hour is not to be overwhelmed, but to collectively overcome. The August 6, 2021 statement emphasized that the RBI remains in whatever it takes mode, with a readiness to deploy all its policy levers, monetary, prudential, and regulatory. As the second wave waned, the October 2021 statement started guiding the economy on its course to normalize and entrench the recovery in an Indian trajectory, notwithstanding diverging paths of growth globally and differing monetary policy stances. By the time of the April 17, 2020 statement, it was clear that providing system-level liquidity was not going to be enough because impediments like risk aversion among banks were standing in the way of further intermediation towards the small, the disadvantaged, and the truly credit-constrained. This brought out the third important characteristic of Governor's statement, which was a wide consultative approach, which involved reaching out directly to all those entities which had been impacted by the pandemic the most, including small non-banking financial companies, microfinance institutions, and even vaccine manufacturers. As I mentioned, when inducements to banks to lend did not work, the RBI reached out through the financial institutions, the All India financial institutions, to on-lend to the rural and cooperative institutions, the MFIs, and the housing finance companies. In subsequent months, this approach led to the fashioning of liquidity lines and regulatory relief to specific sectors identified for restructuring, to emergency health services, to contact-intensive services, and even to individuals and small businesses. Fourthly, the statements in themselves became an instrument of policy by providing consistent and credible forward guidance, especially to financial markets. This assumes central relevance because by that time, the RBI had already acted on all its conventional instruments to the extent practicable and had embarked on many unconventional ones. The statements emphasized that financial stability, congenial financial conditions for growth, and the orderly evolution of the yield curve are public goods. And both market participants and the RBI have a shared responsibility in securing cooperative solutions. By the time of the October 2020 statement, governors' words started contemplating the road to recovery, looking back at the hitherto untraveled road and calling upon the courage to hope, to strive, and to revive. Attention turned to qualitative aspects like deepening financial markets, digital payment security, financial inclusion, consumer protection, and innovations in payment and settlement. Through those troubled times, India became one of the few nations in the world that ran its real-time gross settlement system of swift, seamless, and sound transfers of funds between banks and their customers 365 into 24 into 7. Fifth, the statements became the glue of a new innings in monetary fiscal coordination. Pandemic-related fiscal stimulus exacerbated fiscal deficits and resulted in record levels of market borrowings by both central and state governments. As the December 2020 statement pointed out, the RBI's role as debt manager and banker to the government was tested to the hilt. A recurring theme in several statements has been that the RBI's policy measures ensured the lowest borrowing costs in nearly 2 decades and the highest maturity of the stock of public debt, while ensuring the smooth passage of the borrowing program. For the states, ways and means advances limits were enhanced, and rules governing withdrawals from the Consolidated Sinking Fund were relaxed. Liquidity facilities were linked with credit guarantee schemes offered by the government. A shining example of monetary fiscal coordination of that time was placed on record by the statement of April 7, 2021, which was the maintenance of status quo in the monetary policy framework by the government. Excuse me. Entrenching a regime in which the inflation target is set by the government and the RBI is mandated to achieve the target. Yet another instance that the statements of June 4, August 6, October 8, and December 8, 2021 underscore is the set of strong supply-side interventions by the government that broke the back of then stubbornly elevated food inflation and brought headline inflation back into the tolerance band of the RBI. Sixth, the statements brought to bear first-hand views from governors' interactions in various multilateral fora on global developments and the outlook, and the implications of global spillovers for the Indian economy, as well as for the setting of monetary policy in India. In hindsight, these insights turned out to be invaluable in a situation in which several emerging market economies were jumping onto the bandwagon of tightening monetary policy, and advanced economies were announcing normalization of policy or were joining their emerging market counterparts in raising interest rates. India has held its ground so far and is among a few countries that have retained an accommodative monetary policy. In fact, the statement of December 8, 2021 stated it vividly. It said, "Our motto is to ensure a soft landing that is well timed." Yes, there has been criticism that RBI has fallen behind the curve, but only time will tell whether or not India got it right so far. The approach has served us well and has helped in charting a course for ourselves into the future, which is different from the rest of the world. Now let me conclude. In the hallowed tradition of central banks, the RBI as an institution shuns the glare of the limelight, preferring to remain unglorified and grounded. Yet, when the chips are down and crises loom, it rises up from the depths that it inhabits and flings itself at the gathering storm. When the job is done, the recovery is secured, and macroeconomic and financial stability ensured, it falls back, usually unsung, but always on guard. The pandemic continues to shape the future, but the RBI remains armed and battle ready. Continuously evaluating highly volatile and uncertain conditions and remaining prepared to protect the economy from shocks, the RBI has committed all its instruments to this objective, using conventional measures and fashioning new ones, as the pandemic experience has shown. Going forward, the lessons of the pandemic will be imbibed and the RBI will emerge stronger and more resilient than before, committed to its mandate of price stability, keeping in mind the objective of growth. Thank you very much.
Thank you very much, Dr. Patra. Is so inspiring and so full of hope. And the way you mentioned that, it shuns publicity. I think it is so true and it should not be so. Coming from the kind of innovation and creativity with which RBI is facing the pandemic, I do hope more number of citizens in the country, in fact, learn from you and know that you are doing tremendous work, the 3365 into 24 into 7 days, and the kind of work that you've done. I think you should not shun, publicity. People must know what the RBI is doing. We have hope in this institution too. And not many know. It's so mystified, the institution. I think people must know more about it. I would say CSD should also, in fact, publicize the speech everywhere. And the 13 points really gave me the fire, and feel a hope that I think we are on the right path. There's a lot that can be done, that must be done, but I'm so glad that you ended it on such a nice note of hope. we just soared high. It is now for Sujit Kumar Mishra, our director, who present a vote of thanks.
Yeah, I would like to request Professor Sunny Jose to place the formal vote of thanks.
He is
Over
the
to you.
RBI chair of the CSD.
Yeah. Thank you,
Sunny Jose.
Professor Sujit. It is an opportune moment for the Council for Social Development to express our gratitude and thanks. First and foremost, we express our profound thanks and gratitude to Dr. Michael Debabrata Patra, the Honorable Deputy Governor, Reserve Bank of India. He was kind enough to accept our request, in fact, showed keen interest and was eager to visit this important lecture. His commitment to make himself available to deliver this lecture despite his busy and really demanding schedule. His insightful lecture, as we all listen to now, dealt with a range of issues. In fact, from how the historical memory, absence of historical memory, in fact, led to the irrational aspects, and a brief history of the pandemics and how central banks play a pivotal role during such times. Specifically, his lecture gave us in considerable detail the specifics of policy measures and critical insights on how RBI spearheaded the response to COVID-19 pandemics and how it ensured the resilience of the financial system and restored the health of the economy at large. In short, his lecture gave us a glimpse of RBI's vision, its deep commitment, and its strong conviction, and gave us a grounded response, both conventional and out of the box. So we feel immensely glad and befitting that the person of his eminence has delivered this lecture, honoring the memory and contribution of Dr. C.D. Deshmukh. Thank you so much, sir, for this very insightful lecture. We genuinely look forward to many such lectures from you in the days to come. We would like to express our heartfelt thanks to Professor Muchkund Dubey, the president of CSD. His vision and leadership continues to inspire us, and his willingness to engage with our work motivates us a lot. We express our heartfelt thanks to our president, Professor Muchkund Dubey. Equally, we are immensely delighted to express our gratitude to Professor Santa Shinga, the chairperson CSD Hyderabad, for her abiding interest, commitment, and most importantly, her foresighted approach. Thank you so much, ma'am. It is equally important and appropriate that we should express our gratitude and thanks to Mr. Vineet Kumar Srivastava from RBI. He played an important role by systematically following up with us and responding cordially to our numerous requests. Thank you so much, Mr. Vineet Kumar ji. Also, Mr. Vinod Boy from RBI played an important role in helping us establish the necessary connect and extended constant support in organizing this lecture. We express our heartfelt thanks to him. From our side, it is needless to mention that Professor Sujit Kumar Mishra, the director in charge, played a pivotal role from the very conception of the idea to making the necessary connect, constant follow-up to effectively organizing it. Thank you so much, Professor Sujit. And it is very, very important at this time to recognize explicitly that the administration has been a pillar of support to Professor Sujit in this efforts in organizing lecture. Special word of mention of thanks is due to Mr. Prasad, Ms. Pratap, and Ms. Kalpana. Thank you, dear colleagues. CSD would like to extend our heartfelt thanks to the ICSSR and the state government of Telangana for their support and encouragement. And we express our gratitude and thanks to all the participants for attending this important lecture and sparing time for this. Last but not least, and already Professor Shantasan has expressed it very clearly at the very beginning that RBI has been a pillar of support to us by creating an RBI research unit and creating a chair professorship. And most importantly, RBI has been highly encouraging of a work which dealt with social justice and equity. In fact, it is very, very crucial in the issues also came up in the lecture. We are extremely grateful to RBI for this continued support. And in fact, I reiterate the words of Professor Shanta Shinga. We are very eagerly look forward to very active support in the days to come. So thank you so much. Thank you, one and all.
Thank you very much, sir. Thank you very much.